Today on the Breakfast Grill is David Ng, Chief Investment Officer of Huang Investment Management. David is a CFA chartered holder. He has been with Huang Investments for more than a decade and has been CIO since 2006. David has almost 20 years in the industry. Huang Investment Management is the only non-bank and non-insurance backed investment house with assets under management of over 25 billion ringgit. Global markets are currently very euphoric. We also want to find out the kind of investment style you're adopting. And for a start, tell us, are global stock markets currently in bubble territory?
I think when you're referring to global markets being in bubble territory, you're specifically referring to the developed markets, principally the US, where valuations are perhaps not cheap anymore, and where the markets have done well in the past year. The answer to your question is that if you were to look at the PE of the S&P 500, it's probably in the high teens. Right? So from an absolute perspective, it is not cheap. It's probably trading above its historical fair values. But when you're looking at investments as a whole in the global marketplace, there are only a few key asset classes or categories that one would invest in. Or the three main ones would clearly be equities, bonds, or cash. And if one were to compare the relative valuations between equities, bonds, and cash, then equities looks relatively inexpensive. And by virtue of the fact that we are probably entering into an interest rate, a rising interest rate scenario, equities I would think, would still be the preferred asset class for most investors or asset allocators.
Isn't that going against conventional thinking? Because as interest rates rise, then the bonds and the fixed income instruments become more attractive vis-a-vis equities.
I think at some point in time, once interest rates have risen sufficiently and bond yields are offering attractive real returns, that would be the case, and that would probably prompt people to switch back into bonds or bond funds. But as I mentioned earlier, we are now only at the beginnings of a rising interest rate cycle.
Now, let's go back to valuations for a bit. What is called the cyclically adjusted PE ratio, which adjusts the PE ratios for economic cycles. For the S&P 500 right now is above 25, and that is at a level prior to the late 1990s bubble, and was also seen 3 weeks prior to the 1929 crash. So, what can you say about how expensive the US market is?
Based on the figure you've quoted, it is clearly high. My response to that would be twofold. Number one, it only goes to show that the Asian markets or emerging markets are actually trading cheap. And at some point in time, I think the investment community globally would stand up and take notice that, leaving aside tapering, leaving aside the fact that currently there's fund flows out of the emerging markets or Asia or ASEAN back into developed markets, at some point in time, people will realize that growth is actually still present in this region and valuations are cheap, relatively. The second point is I don't think that's going to stop people from continuing to pour money into equities in developed markets or into US funds or into the US stock market, because, as you probably know, investor behavior is such that they tend to chase past champions or previous year's high returners. Right? One interesting fact to point out is that if you look at the S&P 500 from the year 2008 to 2012, the total returns in that 5-year period was 0%. But if you move that forward by a year, the returns for the S&P 500 from 2009 to 2013 was 100%. And that is something that would entice people to deploy money or invest into developed markets or US funds.
So you would expect some spillover of liquidity from the developed markets into the emerging markets?
It's not something I expect to see in the short term, because I think there are still issues or certain headwinds that emerging markets would have to overcome. Number one being the actual implementation of tapering and subsequent tapering, as well as interest rates rising, tightening cycles in some of the emerging markets. But it will come to a point when most of the monies would have flown out, and as I said, People realize that there's sufficient credit, there's still sufficient liquidity in this part of the world, and growth is still here. And then I would expect money to return to where the growth is.
Mm-hmm. Now, coming back home, what are your views on the valuations of the Malaysian market, since a lot of our investors back home here, they have got substantial investments in Malaysia, and Malaysia is a market that has done so well?
The simple answer is it's expensive. Most of us who are investors in Malaysia would realize that the Malaysian market has historically traded at a premium to the regional markets, to our ASEAN neighbors, and continues to do so, especially after last year's strong performance. Now, the second question that a lot of people would ask, does it mean then that you do not invest in the Malaysian market? Can the market continue to deliver returns? And to me, the answer is yes. I think that there are specific reasons, there are idiosyncrasies within the Malaysian market which suggest that the markets can remain relatively expensive. Number one, there's a strong domestic pool of liquidity amongst Malaysian investors. We have a very high savings rate. We have got public GLC funds that largely invest in Malaysia, insurance companies as well. And the other point to note about Malaysia is that if you were to compare Malaysia with some of our ASEAN neighbors, Singapore accepted, we've gone through some of the challenges that some of our ASEAN neighbors would be facing or are facing, and the principal one being political risk. It's behind us, and we are already on the road to implementing some of the reforms that have been announced by the government so far.
Now, there are many instances in history where markets have fallen for prolonged time periods. For instance, in the post-depression crash of 1929, the US took 25 years to recover to pre-crash levels. Japan has been in a secular bear market for the last 20 years and the last decades. And even after the recent rally, the Nikkei 225 is at about 16,000, is still way below the 40,000 achieved at the peak. So do these instances derail the case for equity investments over the very long term?
The answer, obviously, for me would be no. But the points you have highlighted, Julian, suggest that the way one should invest, or the kind of funds one should invest in, is something that an investor or retailer has to pay close attention to. A passive type fund, it may be cheaper in terms of fees, but a fund that is passive, that just hugs the benchmark and continues to be fully invested through thick and thin, would deliver those sorts of returns. If you have held it, for example, in the Japanese example, if you had held it from the peak until today, you'd still be sitting on significant losses. So the key for us, and what we've been advocating to our investors and our clients, and this also is in line with the way we manage money, is that we manage money from an absolute return perspective. If we think the risk-reward is not in favor of being invested in the market, we have no qualms about raising cash. And an extreme example, but in 2008, in the midst of the global financial crisis, some of our equity funds held on to about 55% cash, which is very unusual for most fund managers, especially those that are relatively inclined.